So Edward Jones, financial advisor, Daniel A. Nobles. Hey, Mr. Daniel, how are you this morning?
I'm good. Are y'all nervous?
No. Are you freaking out?
Erin
Heck
McCarty.
no.
Pardon me, Daniel.
Yes,
Erin
sir.
McCarty, surprisingly, amazingly, shoot from the hip, freak out if things come a little bit off the rails. Erin McCarty is, in fact, right now, the calm one in the room. She says, take a deep breath, America.
Chill.
We're still way ahead from a year ago. You tell me, is Erin right, and what's going on with the stock market?
Erin, I'm so proud of you. Hey, Robert, it is very easy to panic right now, especially with the last year that we've had, especially from 2008 to now. I mean, look, the markets have been phenomenal. As fun as honeymoons are, we all have to come home and go back to work at some point. Mm-hmm. What we're seeing right now is normal market volatility. This is a normal market. This is healthy, and our economy is strong.
But you'll see on all the crazy media, it's the biggest one-day decline ever, Daniel.
Oh, my gosh.
Doomsday.
From the highest we've ever been, though, right?
Yeah.
Right. I think in times like now we need to put market declines in perspective. And if we're going to do that, we should go back to 1900. From 1900 to now, we've had about a 5% or more drop. On average, about 2 to 3 times per year. A 10% or more drop about once per year. And, we've had a 20% drop about every 3.5 years. This is normal. We haven't seen it for about the last, 6, 7, 8, 9 years, but this is normal in the grand scheme of things.
If you invested let's say $10,000 last year, I saw a report that said that $10,000 is still worth $13,000 today, which is pretty darn good return.
Yes. Truth of the matter, if you started in January 1 of 2016 and you let your money grow all the way to December 31st from 17 to 17, the last couple of days, right now, it's basically set us back to January 1st. So you're right back where you were about a month ago.
The most common explanation or theory over the last couple of days for the market drop is, well, a couple. One, that it's the Federal Reserve and fear of inflation. What do those two have to do with each other? And how is a concern about inflation having anything to do with what we've seen in the last 2 days?
Well, when the wages report came out, and it sounds like everybody is making more money because we are, automatically that is going to start setting things, that's going to set inflation off, and the Federal Reserve is going to potentially talk about raising interest rates. But the new guy that we have in there is talking about doing everything that the old guy used to, which is we will be raising interest rates, but we're going to do it slowly and incrementally, and we're not going to get out of control with it.
What does that necessarily have to do with a whole bunch of people panicking, or not necessarily panicking, but selling their stock?
It's panic is what it is. Everybody's acting on emotions right now because, the market hit all-time highs, and, the term bubbles get thrown out, and, oh, my gosh, inflation is about to just go out of control. What do we do? Look, this is a volatile market, and it is very emotional, and that is where taking the proper amount of risk is so important.
Still a good time to invest, Daniel? I mean, when it falls, you'd think, I'll put some more money in.
The advice that I'm giving about this to all of my clients are this. Market declines, they're frequent, and they are not, most importantly, it's not a reason to sell quality investments. They begin and they end without warning, typically. And they do, just as you said, they provide great buying opportunities.
What about somebody who's really close to retirement? Is that the person we're most concerned about today?
Hopefully they sought advice from a financial advisor like me or someone in the industry that does what I do before, and they were pumping the brakes and not putting the pedal to the metal up to retirement. What I literally mean is moving money out of the stock market and easing it into bonds.
Okay.
Doing that, as boring as bonds are right now, and especially with interest rates rising, the defense they provide, my clients that are owning bonds right now are so happy they got it, because if the market's down 5%, they are not.
It's interesting that investors, that advisors like yourself will always say, balance is the key. Explain to folks what that means. because where sometimes, and you just sort of touched on it, where like if your stocks are going down, something else is solid or going up. Explain how balance in your investments works.
Okay. So you want to have a good mix of quality stocks and bonds at the end of the day, whether that's made of mutual funds or individual equities or whatever, but you want to have a good mix of stocks and bonds. So stocks are a lot more volatile, and they are going to provide the growth in your portfolio. Times like now when people start panicking, they are going to drive the value of stocks down because they're selling them off. Supply and demand. Now there's all of a sudden a huge supply of stocks, which is lowering the price.
But if your retirement's not imminent, you wouldn't tell me to go move my stuff into bonds today, right?
No. In fact, I would tell you exactly the opposite. If you owned bonds before, those people that are selling off their stocks, they're wanting to put them somewhere safe, whether that's a really short-term bond or a U.S. Treasury, or they're wanting to go more long-term in their fixed income investments. Your bonds typically rise when stocks fall. And I'm going to tell you to do something crazy.
What?
I'm going to tell you to sell some of those bonds while they're rising and move them into that sinking ship.
What a nut job you are, Daniel. What a nut job.
This is rebalancing. It's healthy for your portfolio. It needs to happen. If you haven't rebalanced your portfolio from 2008 to now, then you probably have a tremendous amount of money in stocks.